Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thank you very much for listening, and as usual, please don't forget, take some time to like my video and subscribe to my channel. That will be really appreciated. So in today's video, I will be talking about what happened in the markets last week, and I'll be also talking a little bit more about our performance, and then I'll be going over some key charts. So let me get started. So last week, our portfolio performance was pretty good again. Our portfolio was up by about 1.58%. If we compare that to the benchmarks last week, we slightly underperformed the Nasdaq, which was up about 2%, and the S&P 500 was up about 1.8%. And that was mainly because obviously the S&P 500 and Nasdaq had strong weeks, but Europe underperformed last week, and China performed pretty well last week as well as Bitcoin, and a lot of the altcoins were also down last week, which meant we underperformed slightly against those main indices. However, our portfolio performance for the year has been really great so far. Our portfolio is up about 16.42% for 2023. If we compare that to the S&P 500, which is up 11.5%, then I think our portfolio has done pretty well. The FTSE 100 is up only 2.09% for the year, and the Hang Seng Index, which is the Hong Kong index, is down about 3.66%. And Bitcoin is up a whopping 63.24% for the year. I also conducted a lot of short-term trades last week, which I had great success in. The main reason I do those is to try to reduce some of the volatility in our portfolio, so I'm able to go both long and short on specific short-term opportunities. And last week I did trades in wheat, as well as the US dollar and the Swiss franc forex pair, and also UK 100, which was a short, and also did a short-term trade in orange juice as well. So that was quite successful last week. If we look at the main news from last week, as I said, the Nasdaq and the S&P 500 produced strong results. And actually, last week for the Nasdaq, it was actually the 6th week in a row increase. As I've said previously in other videos, the Nasdaq is a little bit lopsided at the moment because just a couple of companies within the Nasdaq are really driving that performance, such as Nvidia, etc. Last week, actually over the weekend, we also saw the OPEC Council, which is made up of oil producing countries throughout the world. They actually met up last weekend and actually came to an agreement to cut oil production in order to boost the oil price, and markets initially responded quite well to this. I think the majority of the reductions are going to be made up from Saudi Arabia, amongst other countries. We've also seen the House of Representatives of the US pass that debt ceiling bill, and actually it was voted on by a really large margin. But it didn't really seem to have much effect on the markets last week, and I think that's because it was priced in that there was an agreement in principle from the week before in order for that ceiling to be extended. So once it actually came around to passing the bill, the limited impact had on the markets. We also see some job figures, and the unemployment rate in the US rose to 3.7 from 3.4%. This was seen as relatively a good thing in the market because the higher the unemployment rate is, the less likely they are to increase those interest rates much higher. However, the market is still heavily pricing in a interest rate rise at the next FOMC meeting in a week or two. And it's expected that they'll probably increase the interest rates by about another 0.25%. If we look at the Eurozone now, and in Europe, inflation in Europe has now slowed to an annual 6.1% in May, and that is down from 7% in April. The consensus estimates were around 6.3%, so that's actually surprised to the downside, which is really good. And that is showing that in Europe, they're actually making quite good progress now on tackling inflation, albeit they're a little bit far behind the US because it took them a lot longer to increase those interest rates. Plus, they also had the effect of the Russia-Ukraine conflict accelerating the price of energy, etc. last year. We've also seen the European Central Bank President Christine Lagarde. She reiterated in a speech last week that inflation, although had come down significantly, it was still too high. This is why they have hiked rates at the fastest pace ever. And it's become quite clear that we need to bring interest rates to sufficiently restrictive levels. So they are really still having quite a hawkish line on inflation and also what they're going to do in terms of interest rates. And it's quite likely that in Europe, in the Eurozone, they are likely to continue to increase those interest rates for the time being and keep them in place for a significant amount of time. We also saw a survey last week by the Bank of England, which indicated UK companies intend to raise output prices and wages over the coming year, although they are expecting that pace to slow relative to a month ago. They plan to raise prices by 5.1%, down from 5.9% in April's survey, and they do also expect increases at about 5.2% in terms of salaries, with the 5.4% recorded in the prior month. So it's really showing that companies in the UK are expecting prices to increase and also salary costs to increase significantly over the next kind of couple of months. Although inflation is starting to come down, it's starting to have to be put into prices of consumer goods, and the cost of providing services, etc., has increased. We're also seeing China's PMI has fallen to below forecasts of 48.8% in May, and that is from April's 49.2%. So basically, in the PMI, anything below 50 actually shows a contraction. And what we're seeing in China is that after there was a lot of optimism around the reopening and putting away the restrictive measures of COVID-19, we're starting to see a slowing in the economy, and it's taken a lot longer than expected to ramp up a lot of those demand for products and services, etc. So we are starting to see that seep through to the market, although the Chinese and Hong Kong indexes did do comparatively better last week. We've also seen new home sales in China by China's top 100 developers rose to 6.7% in May, and that is from a year earlier, down from the gains of more than 29% in the previous 2 months. So we all know that last year we saw some significant weakness in housing developers in China as the bubble began to burst on the housing market in China. We've seen some stabilization of those markets over the kind of previous couple of months beforehand, but now we're starting to see a slight slowing again of the housing market in China, which is indicative of the overall market. As we move on to our top 3 performing stocks of last week, and our top performing stock of last week was Coinbase, and that was up about 13.4%. Coinbase has been one of the biggest gainers this year in the markets in 2023, but that has to be remembered, that is on the back of a very poor 2022, where it threw down significantly, and it's just starting to make up some of those gains, but it's still very far away from its all-time high. The second best performing stock in our portfolio last week was Magnite, and that was up about 12.82%, and that is obviously on the back of a very good week last week for tech, and it's an sell-side advertising company. And also the third best performing stock for last week is Amazon, and that was up about 11.28% last week. And again, it has been a great year for Amazon so far. As we move on to our Death by Charts edition, I just wanted to highlight our chart to the left, which is the volatility index, also known as the VIX. And I really was just wanting to show you that we're at the lowest level since February 2020 in terms of volatility. And as everyone will remember, Feb 2020 was towards the start of COVID-19 before it spread around the world. And obviously we had a spike up in volatility after that. But it's just showing that the volatility levels have come down significantly and the markets have started to calm. The chart to the right I wanted to show you is the global container rates. We're talking about 40 containers and are lower today than they were in February 2020. Again, that was pre-COVID. So we had that massive spike up over COVID as there were supply chain issues and the cost of global containers increased significantly, and those are now down to lower than even pre-COVID-19 levels. So I think there's some quite good upside to be made on some of those global container and freighting companies such as Zim Shipping, which is in our portfolio. And I think we could be very close to bottoming in the global container and freight industry. The third chart that I just wanted to point out there to the left is the US total assets held by the Federal Reserve Bank. So it's basically the total assets held, so it's basically the balance sheet. And as you all know, last year in 2022, after massive stimulus had been put into the markets in 2020, 2021, the US Federal Reserve, they tried to reduce the balance sheet as much as they could last year to try to reduce the overall total assets on the balance sheet, and they managed to do that reasonably successfully last year. We all know that after that there was the Silvergate, Silicon Valley Bank and other banks that really struggled at the beginning of 2023, and the Federal Reserve and the US government had to put initiatives in place in order to save some of those banks and provide loans on some of the long-dated bonds, etc. So they really injected new liquidity into the markets by temporarily increasing the balance sheet. However, over the last 10 weeks, they've managed to reduce that pretty close to what it was before they injected those loans into the economy. There were a lot of people saying that those loans that they put into the economy would be more permanent and they would increase over time. But actually, we've seen that come down significantly over the last 10 weeks. The chart to the right I just wanted to show you is the market expectations for federal funds rate, which is basically the interest rate. And what the market is showing is it's showing an expectation of increased rates for the next FOMC meeting, and then after that they're expecting cuts to come as early as kind of November 2023, and for that to be quite slow cuts all the way to kind of December 2024, when the market's expecting interest rates to come down to about 3.5%. I think personally that's a little bit too positive and a little bit too optimistic. I expect them to keep the rates at a sustained level. Even if they freeze the overall interest rates, I expect them to stay like that for a significant period of time, probably through to at least the end of 2023 before they start making cuts. However, it does have to be said that any kind of black swan events or grey swan events in which something happens where basically the economy breaks and we go into kind of a more severe recession, that would lead to a change in monetary policy and a change in interest rates. where they could be forced to cut in an emergency and maybe are forced to cut a lot quicker than be expected. But just the way things are in the market at the moment, I do expect interest rates to be pretty similar to what they will be after the FOMC meeting through to the end of 2023. As we move on now to our crypto news and views, and crypto was relatively stable last week as I'm recording this video on Monday, and basically crypto was sitting at about 26,800 at the time of making this video, and it stayed pretty calm over the last kind of few weeks at least. And as I've said before, I think it's taking a very similar route to what happened in 2019, as we're a fairly similar stage of that in the market cycle. Altcoins aren't performing that so far over the last couple of months since that surge in January, and I think that is mainly because we're still in a kind of a risk-off type of environment, and Bitcoin has held up a lot better than a lot of the altcoins. However, I'm still pretty positive on crypto, and especially Bitcoin, throughout the end of 2023. However, I'm not expecting a new all-time high until at least 2024, after the coin halving cycle, which takes place every 4 years. So just to move on now to our first piece of news, and JP Morgan actually released a report last week in which it said that it thought that Bitcoin was undervalued at its current rate, and said that it should really be up about another 23% from where it is currently at 26,800. So I think that was about 34,000, etc., maybe a bit more, 35,000, what it was saying should be fair value. The second piece of news that I wanted to bring to you was Gate.io, which is a crypto exchange. There was a lot of news last week that they could be facing liquidity issues, and this caused a lot of concerns as people weren't able to withdraw funds, etc., from their accounts. However, I think this has since been sorted out, and they've released various statements to say that they haven't got liquidity issues and that they should be all right moving forward. However, everybody should be careful of what they have in these crypto exchanges, because as we all know, not your keys, not your crypto. So last chart that I wanted to show to you was about crypto, and the chart that I really wanted to show to you is quite a simple chart really, and what I really wanted to put across was that during crypto cycles you see a lot of FOMO, and we see FOMO really in all technology cycles where we're dealing with innovative technology. So this chart really shows that in blue is artificial intelligence, in red is Bitcoin, and in that kind of dark black, navy blue is around the metaverse. And what you can see is this chart really shows the Google searches worldwide for this specific technology. And as you can see, when you have a high amount of Google searches, this usually leads to a spike in price of either stock prices or crypto prices or metaverse prices, depending on which sector and which innovative technology has taken off. So really what you want to be doing is you want to make sure you invest in innovative technology, definitely, but you need to make sure that you invest at the right time. You don't want to be investing in it when it's blowing up through the roof. For example, right now, AI seems to be the buzzword. Any company that talks about artificial intelligence within the annual reports or within the conference calls, etc., and their earnings tends to lead in a big spike in price. So it's that buzzword at the moment. And that is mainly because of the success around ChatGPT, etc. And we've seen a lot of rises in those stocks which feature artificial intelligence, such as Nvidia, in recent weeks. But that is not the right time to be investing in this technology when it's already It's already taken off. The prices are ridiculous, valuations, etc. You want to be investing in these types of things when the markets have come down. It was a very similar situation in 2021, towards the end of the year, early 2022, when everybody was talking about the metaverse and every company wanted a space in the metaverse, etc. And the prices of metaverse cryptos, as well as companies that mention the metaverse like Meta, etc. This kind of led to prices going up quite significantly towards the end of the year, and as we've seen again, they've come down significantly as well. And it was the same kind of during the Bitcoin and crypto bull runs, end of 2017, where searches for Bitcoin went up significantly, and then obviously at the end of 2021, where Bitcoin peaked as well, we also saw a spike in Google searches around Bitcoin as well. That has come down again significantly, which does illustrate again it could be a good time to increase your crypto positions. Think about taking those crypto positions when there's no FOMO in the market, when nobody's talking about it, and then you hold those crypto positions until there's a lot of FOMO again in the market, then you can start to take profit. Okay, so that's it for my video today. Thank you very much for listening as usual. If you haven't joined my Discord group already, have you been living under a rock? You have to join. We have really awesome discussions every day, every week about things that are happening in the market. People are able to ask me any questions at any time. So if you haven't, join today. Thank you very much and have a great week ahead.